The pulling back of money creates its own problem because now, with less money in the asset class, it's harder to refinance. Those loans can't get rolled over to the same extent they might have been otherwise, which actually creates an increased default risk. So there's a little bit of a spiral effect, like a bank run, that's happening now in private credit.
Dan Rasmussen, thank you so much for joining the business.
My pleasure. Thanks for having me on.
Is private credit in crisis?
Absolutely, David. We're in the early stages of a crisis here. What you're seeing is that people are realizing, and this is not should not come as a surprise. Private credit was offering yields that were very high, much higher than you would have earned from safer fixed income instruments. And all of a sudden, investors in these high yielding vehicles are learning that the marks are coming down, and that maybe they're not going to earn the very high yields they were promised.
The important question I think that most people want to know is the biggest threat to private credit the growth of AI?
Yeah, look, this is in some sense a story as old as time, right? I think people forget that efficient markets are efficient when they enter the world of credit and lending. And there's a very simple rule, David, which is that the higher the yield that you demand when you invest in something, the higher the risk of bankruptcy that thing has, right? That's what efficient markets mean, right? If you have a friend who comes to you and says, "Hey, the bank won't give me a mortgage. Will you give me a mortgage and I'll pay you 15% a year?" Your first instinct shouldn't be, "Wow, this is a great opportunity for me to earn 15% a year." It's that my friend has really terrible credit. And so,
There's
yes,
always risk there.
there's always risk, and the risk is importantly proportional to the yield. And private credit offered investors high yield with, they said, low risk and low defaults. And now what we're learning is, oh my gosh, what a surprise. There actually is risk, and there's real default risk. And AI is showing where the risk might be, which is in these software loans, which are somewhere between 20 and 40% of the lending books of these different private credit lenders. But even without AI, these were risky loans. They were lending to companies. Software companies don't have assets, right? Like if the software business goes south, what do you seize? Like the code, they have no factories, they have no trucks, they have no fields, they have no real estate. And so it was always risky. And what we're finding out is that now AI poses a threat to the revenue and the profits. And so all of a sudden, investors are dramatically repricing these loans.
Now, when you say investors are dramatically repricing these loans, there is this idea that investors are asking for their money back, which leads, I guess, the technical definition for that is redemptions. How serious are the redemptions at the moment?
In some vehicles, existential. So Blue Owl is the poster child. They're one of the sort of lowest quality lenders. I think they had 40% of their investor capital submit for redemption, right? So that's like you're going out of business, right? Like 40% redemptions, you're going out of business. On the other hand, there are some very high quality lenders that have maybe seen 5 or 10% redemptions, which are totally manageable. So it depends on the quality of the loan book. But the challenge here is, David, is that flows, so money moving in and out of the asset class, anticipate, right, and predict what's going to happen, right? So people are pulling their money because they anticipate defaults, and they're not wrong. There will be defaults. So the flows are happening in anticipation of a bad event, which will happen. And the pulling back of money creates its own problem because now, with less money in the asset class, it's harder to refinance. Those loans can't get rolled over to the same extent they might have been otherwise, which actually creates an increased default risk. So there's a little bit of a spiral effect, like a bank run, that's happening now in private credit.
Okay, so in the lead up to the global financial crisis in 2008, 2009, banks were sitting on collateralized debt obligations, CDOs, that ended up being worthless, and it led to a credit crunch in the public, amongst public banks. What I'm curious about is essentially private banks. So it's not really making mainstream news yet. So do you see the sort of the same ingredients at the moment in private credit as existed prior to the global financial crisis? And does that mean anything?
On the one hand, the story rhymes exactly, right? Which is that people are lending money to something that is a high yield, expecting high return, and then finding out at the worst time that the reason it offered a high yield was that it had high bankruptcy risk. And that happened with these subprime mortgage securities, and it's happening with what are essentially subprime corporate loans. On the other hand, the Federal Reserve in the United States, the sort of origin story of private credit is that after the financial crisis, the Federal Reserve stepped in and said banks can no longer hold these type of loans on their books. They can no longer do this because it's too risky. This low quality lending ends in disaster. And therefore, the private credit industry emerged to step into the hole that had been left by the banks. That was a very proud origin story for many private credit firms. They said, oh, the banks are dumb and the regulators are dumb. We're going to make all this money. And they did make a lot of money for many years. But now we're seeing the prudence of that regulatory action in that this stuff is not on bank balance sheets. It's on Blue Owl's balance sheet. And who cares if Blue Owl blows up, except for the people that invested in Blue Owl itself?
Yeah, so sure, nothing to see here, folks, then.
Right. So basically, who are the holders of private credit? It's the one risk here is that there's a fair amount of it that's on the books of life insurance and annuity firms. And so there's some risk there, right? Because we don't want to let people that bought life insurance go belly up just because the people that own the life insurance company made bad investment decisions. That's the one place where I think this is scary. But again, it's not on the balance sheet of systematically important institutions like it used to be in the subprime crisis.
Well, Dan Rasmussen, I think the one question that everyone wants to know is, could this blow up?
Well, it is blowing up, David. And I think the question when you have these types of blow ups is that you learn who the holders are of this, right? So I think the optimistic view right now is this is contained because the only people that own private credit are big boys that can handle the crisis. What we don't know yet is where the surprises are going to be. Somebody that we didn't expect, maybe it's your local foundation that you rely on. Maybe it's some pension scheme that owns this in a much greater degree than you would have thought. And as these things continue to blow up, we're going to find out, for better or for worse, who those people are.
What's the worst case scenario?
The worst case scenario, in some sense, isn't that bad. This isn't that big of an asset class. It's a small and contained problem. The challenge is that in financial markets, big crises always start from small problems. Ben Bernanke wrote about this. He called it the financial accelerator. That a change in some small asset class can change the financing environment. It can change investor attitudes. It can turn people to saying, I need to be risk off right now. And that's where small shocks turn into big crises. We don't yet know who the surprising holders of this are. We don't know how it's going to affect investor behavior or sentiment. But I think we're in early days, David, so we need to keep watching this and keep observing as these things continue to unfold. What are the unexpected stories that come out of this?
Dan Rasmussen, thank you so much for joining the business.
My pleasure, David.